current thoughts on the banking and where it's going and getting, where things have headed after the Royal Commission and equity?
Yeah, I've been doing quite a bit of work with a few banks recently, and always good fun sitting on the opposite side of the desk to where I spent my formative years. The Royal Commission's thrown a few spanners in the work, to be honest with you, Tim. What we're seeing typically is a couple of really live examples I've got going at the moment. Increased diligence on the credit assessment. So banks need more than ever to be confident that anybody borrowing money can repay that debt. Now that sounds really simplistic. Back when I was cutting my teeth as a banker, you had enough security and you made a small profit, we'd write you the loan by and large. The sorts of things we're seeing now is much deeper requirement for them to demonstrate servicing capability. A lot more diligence in terms of what are the fundamentals behind your projections. So what is your assumed yield? What's your assumed price? What are your assumed costs? And can they reconcile that back to your historical performance, your historical financials? And the comment made to me by a really senior banker yesterday was, we just, excuse my French, we're sick of bullshit cash flows. They've got to be meaningful. They've got to be conservative and achievable. One of the comments I've seen a lot and had a number of clients approach me with now, banks are no longer able to do cash flows for their clients. They shouldn't do it. The customers have to do it themselves. So they're often approaching guys like you and I, Tim, to do that. They're accountants, but the banks can't doctor the cash flow for them anymore. The other thing that is changed really significantly is getting some separation between the credit decision, can you borrow money, and the valuation of the security you provide to secure those debts. Typically, again, back in my days, you'd value the farm at about 60 k's an hour with your elbow out the window as you drove past. Those days are gone. They tend to have either completely externalized that valuation process, or have got an independent internal valuation team who do not have anything to do with the credit decision other than saying that's the value of the security. So that's moved away from a lot of the vested interest. If I'm a banker, I get my next bonus by lending money. If you don't have enough collateral and I just tweak up the valuation of your farm, I could potentially write a loan that I couldn't have otherwise. So they're trying to decrease that risk and that exposure for the banks by getting some separation in that part of the process. All of that, Tim, has manifested itself. They haven't magically got more staff on board to help. They've got a more in-depth credit analysis requirement. They've got greater resource required to undertake valuations. Banks have outsourced that to professional valuation companies who are now bogged down in work. So the days of going to the auction and giving the banker a ring and thinking you're going to buy the joint next door with 30 days or 60 days to settlement are probably a thing of the past. The whole system seems to have slowed down. And I suspect the COVID piece over the top of that has, people are working from home, they're not having access to the sort of support and resources that they did have. And we're just seeing that time from application to approval and then to draw down of a new loan seems to be getting significantly longer. I think also probably part of the COVID piece is watching the bank reporting season. NAB this morning down nearly 40% profit, CBA and ANZ down 40 to 60% on their annual profit projections. They're hurting, and there's been slow payment from customers. The interest rate environment's not helping them. They're going to find ways to try and claw a lot of that back. So watch this space on that. To that end, I think the cost of valuations has been the first thing I've seen that's being passed on in full to customers. That wasn't a cost that we previously had, and one would assume that they're probably going to look to find more ways to generate revenue and to minimise their cost base. NAB came out and made a statement last week that they're deadly serious about reducing overhead costs in their business. So how they manage to do that and resource and improve the speed of lending is anyone's guess.
I don't understand how they can do that, because they've lost a lot of resources over the last 20 years. That's been the one thing they've done, is they've cut out a lot of frontline resources to make money, and now they've put more work on these guys. So
yeah, they reasonable chunk of that loss has been provisioning for bad and doubtful debts. So presumably better lending practices will remove that, and if we can move past the coronavirus lockdowns and all the economic doom and gloom coming out of that, that should presumably lift some of that too.